How is housing pricing doing right now in Jacksonville?
So pricing is doing great. So, no one really knew what was going to happen, obviously, with COVID affecting the market, but inventory has still been low and sales have been really strong. So to give you the actual numbers, in April, the median home price in Jacksonville was $250,000, which was up 8.7% year over year from last April. So, I mean, obviously 8.7% is a huge increase. And that was a little bit due to the fact that April was kind of artificially low last year. When you get data month to month, sometimes, so one month can be high, one month can be low. So you really try to smooth it out as much as possible. But overall, $250,000, that was what the high was last year. So in April, we're already at our yearly high from last year. And typically we don't see a high until June or July. So we still expect prices to continue to increase, probably just a little bit throughout the summer. So pricing has still been holding really, really strong. And anecdotally, just talking to a lot of different investors that are renovating and selling houses, real estate agents, even though sales volume is down because inventory is still down, because listings are down, stuff is still moving. So you're seeing, when properties are hitting the market, if it's a good property and it's priced right, it's getting a contract in a week. So we haven't seen days on market go longer. It's been great. The market has been holding really, really strong.
That's great news. I want to add some context to that. If you are looking to buy a rental income property, is the housing pricing, the current housing pricing, how should you be considering that? Like, is the fact that it's going up in price good news, bad news, indifferent?
So the best way to answer that question is really indifferent. So in the long run, you can expect home prices to appreciate. And that's why you want to buy in a market that has long-term home price appreciation. For instance, Jacksonville, long-term home price appreciation is historically over the last 50 years has been over 4%, where you might, a lower growth market in the Midwest might be more like 1% or 2%. So you want to buy in the right market where you can plan on getting appreciation over the long term, but you don't really care what pricing is doing month to month or even year to year. If you're in it for the long haul, you've got, your long-term debt on the property and you're getting rental income, it doesn't matter if the property is worth $240 or $250 at any given month, because you're not selling it. You're in it for the rental income. You're in it for a long haul. So the month-to-month fluctuations don't matter, but it is good to know, that you picked the right market and that the market is increasing in general. So what you asked the question about, is it good or bad for investors? Well, if you've already bought a property, anytime the market's going up, that's great. If you're still looking to buy, then maybe you don't want it to go up as fast, so you can buy your properties at a lower price point, which gives you higher returns. So it really depends on where you're at in filling out your portfolio, if it's a good or bad thing. But the main takeaway is that in Jacksonville, the market is still strong, and you can still get properties that can give you a great cash flow, and you still get that potential for long-term price appreciation. So all good news from the data about real estate, despite the headlines that you read and the concerns, rightfully so, concerns about COVID.
And Alex, let me just add a couple of things there. So, the number one most important thing when you're buying rental properties is to get positive cash flow. And like Alex was saying, the rent and the prices in Jacksonville allow you to get that. That is very different than a lot of other markets out there. There's really only a handful of markets across the country where you can get positive cash flow, including all of your property management fees that you would pay in a neighborhood that you want to own properties, right? So we have that in Jacksonville. But the other thing, Alex, I just wanted you to kind of explain, this is something that I talk about a lot, and people still don't get it, or it's still hard for them to comprehend. But I talk about the fact that real estate appreciation is not speculative if you hold on for a market cycle, if you hold on for a 10 to 20 year period. Can you go a little bit more in depth into that? Because that is so critical to overall returns for an investor, if you know that it's not speculative. So let's talk about that a little bit.
The easiest comparison to make is to the stock market, right? In the long term, the stock market goes up historically, even though it fluctuates up and down. And so when you look at the numbers, homes in Jacksonville have appreciated over the last 50 years at an average of 4% a year. And if you break it down to 5 years, well, maybe homes, in 2008 was really the only time when homes went down in price. If you looked at it from 2006 to 2011, home prices went down. But if you look at it from 2006 until now, home prices still went up. And so in the long run, even though you might have ups and downs, when you hold on over a period of time, call it 10 years, 20 years, whatever that market cycle is, then those homes will appreciate. And we live this because we bought homes in 2006 that we still own. And they've been great investments, even though, in 2012, when we looked at it, it didn't look like we had any or very much equity. Those properties were still kicking off cash flow. And now we can sell them for a profit. So when you buy into the right market and you're getting a property that's cash flowing, you can count on that appreciation in the long run. You don't have to worry about what the property is going to be worth next week or next month or next year.
Yeah, one of the stats that absolutely shocks people is that what you talked about, how prices tend to repeat themselves or appreciation rates tend to repeat themselves every 10 or 20 years. If you go back from the year 2001 all the way to 2020, where you endured that 35% plus drop in 2008 to 2011, your prices from 2001 to 2020, the average appreciation rate is still over 4%, just like Alex was talking about, which just substantiates the fact that if you're in this game for a long time, you can bank on home price appreciation, and therefore you should take it into consideration when choosing your market. Alex, take people back to 2006 when we were a couple of young guys just buying 40 rental properties. We bought them with cash flow, and then we saw the market dip. Just, take us down memory lane. And we didn't have the insight to know how markets actually fare. What were we thinking when we owned 40 rental properties and had all of our parents' money in this, and the little money we had? What were we thinking then?
There was some scary times in 2008. I'm not gonna lie, but we had the long-term debt in the properties, and they were still cash flowing or breaking even. But yeah, no, that wasn't always fun. Some sleepless nights back then.
Well, the great thing is now we've been through it and we know how this works. We were just going off of books and what we learned, and so we hadn't actually seen it in practice at that point. And there were some scary times, but when you invest in the fundamentals, you invest in rental properties, which is a consistent asset class, and you invest in cash flow positive properties, you have a lot of outs, right? It's hard to lose if you're in this game for the long haul and you invest in assets that pay for themselves every single month. So
we also didn't have a team that had been doing it for 14 years and had been through it all either. That would have been nice.
I'm glad you took us down memory lane a little bit, because I wanted to do a little bit of that too, right? I know that you guys talk about MOI and the effect on short-term pricing for MOI, and I was hoping that you could tell us where MOI is right now. This is months of inventory for anybody that is new to these calls. We talk about MOI a lot. I was hoping that you could give us an update on MOI right now and compare it to that slide of 2006 through 2008 and where it was then.
Absolutely. So months of inventory. So the metric, how it works basically is you take all the properties that are listed on the market. So let's say there's 6,000 properties out there on the MLS, and then you divide it by the number of homes that sold in the prior month. So if 1,000 houses sold in the prior month, you take 6,000 divided by 1,000, and you get a number of 6. So there's 6 months of inventory. If no new homes were listed at the current rate of sales, it would take 6 months for all the inventory to be gone. And it's a great leading indicator because months of inventory is what tells you if it's a buyer's or seller's market. Historically, 6 months is kind of the inflection point, where less than 6 months is a seller's market and more than 6 months is a buyer's market. And right now we're at 3.46 months of inventory. We have been at or below 4 months of inventory since 2014. So we've had a pretty unprecedented run of low inventory, which has caused prices to increase. So this is why home prices have been increasing, because when you have a month of inventory of 3 or 4, then you are naturally going to see price increases because there's the balance between supply and demand. There's not enough supply, and therefore it will increase prices. And we're continuing to see that.